So adjustments related to debtors and creditors. Bad debt, provision for doubtful debt, discount on debtors, provision for discount on debtors. These are the four adjustments we have for debtors. Discount on creditors and provision for discount on creditors. These two additional adjustments available for the creditors. Let's see all these things one after one. Now, in case we have only bad debt, how can we handle this? Bad debt. Bad debt can be linked with depreciation. Like depreciation is nothing but value reduction of any fixed assets. If we have building, say 1 lakh, it may be depreciated at the rate of 10%, means 10,000 might have been depreciated. So hereafter the value of the asset by the end being only 90,000. We lose the value of the assets because of the usage. Because of the usage, the value of the assets may be lost. Clear? Similarly, in case of debtors, the third party has to pay me money for any due, for anything. I made a sale for rupees 1 lakh. For that, buyer tells me to pay it later on. So 1 week or 10 days later. Okay, 1 lakh. I have a doubt whether will he pay comfortably by the end of the period, or will he ask for any discount, or will he make it not payable, like bad debt. In that case, how can we handle that? Will be coming under bad debt. Is that okay? So the value being 1 lakh from a debtor. Okay. And on settlement, he says, I could not pay this 10,000 rupees because of some disagreement or some reason. But he may be not in a position to settle because of the insolvency. Whatever the reason may be, I could not get that 10,000 rupees. I'll get only 90,000. Is that clear? Or from few parties, A, B, C, and D, like 4 parties. From them, we have to receive this one. For example, A has to pay me 30,000 rupees, B has to pay me 20,000 rupees, C has to pay me 10,000 rupees, and D has to pay 10,000 rupees. That's what about 1 lakh. So I made sales to these 4 parties, A, B, C, and D. And later we found that we have to recover 1 lakh from them, and D is abscond, probably insolvent. He went to the court and surrendered himself. I don't have any cash to pay my commitment. Court says, okay, I will take care of it. Don't disturb him. You cannot hereafter collect the money from D because he is insolvent. Court declares he is insolvent. Insolvent means he is not in the position to pay any further debt. Court declares him being the insolvent. Insolvent means solvency position is weaker or no. No solvency position. Once the court declares insolvent, he cannot do any justifiable business hereafter, like borrowing and other things, because the court says he is not being the proper persons to rely on for any payment. So don't forget about him. So it's what about the case? It's what about the case? So we don't get that money. That amount we could not recover from D is called bad debt. How can we treat this? Right. In case of bad debt, this may be given in adjustment usually. If the bad debt related thing is given in adjustments, means we have to pass the journal entry for this. Debtors balance is 1 lakh. And bad debt in this case being 10,000. Means one of the debtors could not pay because he becomes insolvent. So we could not recover. Hereafter, how much we can recover? Only 90. Right. Debtors is a debit balance. To reduce the debtors balance because of this one, so we have to credit the debtors. Bad debt is a new loss. That loss should be debited here. The journal entry in this case being bad debt account debit to debtors. Is that clear? How much? 10,000. This is how you can pass the journal entry. What about the journal entry for the depreciation? Depreciation account debit to asset depreciation, due to the utilization of the asset, the assets value will be decreasing. You are subtracting the value of the assets. Bad debt, the amount non recoverable due to some reasons, is going to be deductible from the debtors balance. And what about the bad debt? Bad debt is a loss or nominal account. Usually it will be transferable to a P&L account. So for that, the journal entry being profit and loss account debit to bad debt. To bad debt. This is what about the transfer entry. Bad debt. Is that clear? So where we have only bad debt, no other thing. If we have only bad debt, the journal entry is very simple. Bad debt account debit to debtors. Later on, if you want to pass a transfer entry, usually we don't do, right? Usually we won't pass the transfer entry, but if you want to, then you will understand P&L account debit to bad debt. Next one is all about if the bad debt is given in trial balance rather than in the adjustment. If it is given in the trial balance, what does it mean? This entry is already over. That's how you have to understand. So as this entry is already over, you have to pass only the transfer entry. The transfer entry is all about P&L account debit to bad debt. Clear? Clear? That's all. So verify whether the bad debt is given in the adjustment or trial balance. If it is given in the adjustment, so you have to pass the adjustment entry and then transfer entry. If it is given in the trial balance, no need to pass the adjustment entry because adjustment entry was already posted. C. We have question number 4, bad debt, no provision. Very simple illustration. Bad debt, no provision. Past journal entries. Okay, you can also record, come on, write it down, Past journal entries. Here what happens, an extract of trial balance is given. In the debit side, we have debtors as well as bad debt. Bad debt in adjustments. Bad debt in trial balance. Apart from that, we have been given the bad debt in adjustments also. Okay, what happens here? Bad debt, we have been given in adjustment as well as in trial balance. If the bad debt given in adjustment, so we have to pass adjusting entry and transfer entry. We have to pass these two entries, isn't it? Okay. Usually transfer entry is very rare. Okay. In case of the bad debt given in trial balance, we no need to pass adjustment entry. We have to pass only transfer entry. Clear? For the bad debt given in adjustment, the first journal entry being bad debt account debit to debtors. This value being 200. And for the transfer, the entry being profit and loss account debit to bad debt. The value being 200. Clear? In case of the item given in bad debt, the journal entry being simply transfer entry, P&L account debit to bad debt. 300. Usually, these two transfer entry can be combined. So if you combine these two transfer entries, the combined journal entry being P&L account debit to bad debt. This value being 500. Clear? This value being 500. Now, on preparation of trading and P&L account and balance sheet. Trading and P&L account and then balance sheet. What happens? We have debtors in balance sheet, asset side, the value being 10,000. Because of this journal entry, debtors is subtracted by this extent, bad debt extent, 200 rupees. Then the new balance in bad debt, in debtors in the balance sheet being 9,800. This bad debt is already we have in debit side. One more bad debt comes here, debit side. So 300 plus 200, 500. This is plus item. 300 plus 200, 500. And the same bad debt is in the credit side, 500 rupees. Credit means minus item, so you can subtract this one. So bad debt account now becomes 0. Initially, we have 300 rupees in the debit side. Because of this journal entry, we have another 200 rupees in debit side. So debit plus debit. Okay, 300 plus 200, 500. And because of the transfer entry, the bad debt becomes 0. Okay, this is minus credit, right? So minus credit, 500 debit minus 500 credit becomes 0. And still we have to post this one, P&L account. In P&L account, in the debit side, to bad debt. To bad debt. This value being 500. Hope so you could now understand how this will be prepared. Clear? So I have now completed the bad debt concept. Bad debt concept. If we have only bad debt, that will be subtracted from the debtors and transferred to the P&L account given in the adjustment. If it is given in the trial balance, only transfer it. Only transfer it. Is that clear? Now, what is called provision for doubtful debts? If we have been given bad debt as well as provision for doubtful debts. Provision for doubtful debts. Okay. Clear? PDD in short, I use this term. PDD. Provision for doubtful debts. Bad debt and provision for doubtful debts. What happens in case of we have only bad debt? We have only bad debt, no provision. Bad debt is a loss. Loss will be adjusted from where? From where? Loss should be adjusted from where? You have to adjust from the profit. Means profit and loss. If there is any bad debt, we have an account called P&L account for adjusting any profit and loss. The bad debt will be adjusted in the P&L account. Okay. If you go to the shop, purchasing a note for rupees 100, how will you make the payment? How will you make the payment? Sir, no doubt, sir. From my pocket, purse, or what about the app I have in mobile, whatever it may be. Clear? If there is a major expenses like Diwali, you spend around 1 lakh rupees for Diwali for celebrating in grand manner. Come on, tell me, from where will you pay this money? My salary itself 25,000 rupees or 30,000 rupees. How can I spend 1 lakh rupees? Then what you can do, every month you can keep around 10,000 rupees salary. In the year end, you are going to celebrate the Diwali. So how much money you now have in that pooling of amount, pooling account? 1,20,000 rupees. Diwali spending 1 lakh. Where from you can take? From that pooling amount. Clear? This is similar to your salary. As you are being the employee, any expenses you spend will be subtracted from your salary, but there is a major expenses. In that case, what happened? Bad debt along with the PDD. Along with the PDD. First, you do one thing. From your P&L account, you keep some money away or aside. That is called PDD. This is the pooling of money. Okay, this is your salary. This is your Diwali fund. Diwali fund. Somebody may do that way also. Every month, 1,000 rupees you deposit. Year end, you will get the crackers for the 10,000 rupees or whatever the amount available. Is that clear? Similarly, from the P&L account, you are transferring the amount to the PDD, provision for doubtful debts. Salary to Diwali fund and Diwali expenses. This Diwali expenses can be met from where? This box. Isn't it? Similarly, bad debt. If we don't have the PDD, that bad debt losses are adjusted in the P&L account. But we have a separate account for meeting this one. So, some amount I am transferring from the P&L account to PDD account, a special account. This PDD is for adjusting which kind of loss? Bad debt loss. So, if actually a bad debt comes, what happens then? This bad debt can be adjusted here. Clear? Clear? So let's see. We have bad debt rupees 100. In this case, what is journal entry? Bad debt account debit, sorry, P&L account, bad debt account debit to debtors, value being 100. Next, this bad debt is adjusted in the P&L account. The bad debt reduces the balance of the bad debt. So that means debtors, the journal entry for that is bad debt to debtors. Actually, the bad debt is a loss adjusted in the P&L account. Finally, all the expenses pooled and debited in the P&L account. Like all the expenses are paid out of your salary. Salary is a P&L account. Like, okay. So you're debiting all the expenses to your P&L account. So for that, the journal entry is P&L account debit to bad debt. The bad debt will disappear. Clear? Now what happens in this case? First, I create an amount. What is your expected bad debts are in the coming year? Coming year, I thought to celebrate Diwali in grand manner. Like coming year, some debtors may become bad. They will not pay. Okay, what could be the estimation? Probably 100 rupees. I'll now create 100 rupees as a separate fund for meeting that expenses. That will be debiting the P&L account. So P&L account debit to what? Provision for doubtful debts, 100 rupees. Step number 1, we have created a provision. Step number 2, actually bad debt happened. For the bad debt, what is journal entry? Bad debt reduces the debtors balance. So bad debt account debit to debtors. The value being 100. Actually, the actual bad debt is also 100. Later on, bad debt loss should be anyhow adjusted, no? From where? Usually P&L account, but in this case, we have a special account called PDD to go there and adjust. So for that, the journal entry being PDD account debit to bad debt. Is that clear? That's all. Any doubts here? So from this, it is very clear. The PDD is a special account to meet the bad debt losses. Like we are creating Diwali fund. Parents may plan for education fees. It's a big problem for the parents. They will make the money ready for May month spending and Diwali spending. Every period, usually it's a habitually nearby your means your residence. You may see some people may collect the money for tours for Diwali. My cousin collects around 2,000 rupees per month from his friends, 10 friends, every month, January onwards. December, 24,000 will be there for every person. Almost 10 persons, 2,40,000 rupees. They will organize a tour by booking a van and other using the 2.5 lakhs. So sudden expenses may be riskier. I don't have money, so create the money, keep it separately. That money can be used for the specific purpose. That creation is called PDD. Once the real loss happens, this loss is adjusted in the PDD. Now, if you club all this journal entry resembles this one. Like if you are combine all this journal entry, what happens? Bad debt got eliminated. The ultimate answer being P&L account debit to debtors, right? This is what about the combining bad debt debit, bad debt credit. If you are merging these two, it becomes 0. Similarly, here also you can combine. PDD credit, debit got cancelled. PDD debit, bad debt debit and credit got cancelled. Ultimately, we have what? P&L account debit to debtors. The ultimate entry is the same. Is that clear? Hope now you'll be able to understand the logic behind creation of the PDD. Now you'll understand that the PDD, like you can create any number of provisions for any purpose. Okay. So if you are mugging up that PDD, seems to be a separate adjustment. No, this is a type where I am keeping the money aside to meet the concerned expenses. Diwali fund, price distribution fund, okay, and tour fund, education scholarship fund, non-profit organization. If you have studied, where you will create lots of fund, using that fund you will distribute, price distribution. Fund collected for annual get together and all. So this is a special account meant for a specific purpose. Now what more to be understandable here, right? See, always remember, bad debt, we create the PDD and P&L account. First you create the P&L PDD from here. This amount can be used for adjusting the bad debt. Step 1, create. Step 2, adjust this. Is that clear? For bad debt, the journal entry is common. Bad debt to debtors is the common. Bad debt to debtors is common. This is common. The thing is, you have to create the PDD, use the PDD for adjusting the bad debt. Is that clear? Scenario 1. Scenario 1. Bad debt is 100. Bad debt is 100. Scenario 1. We created 100 rupees PDD and bad debt is 100 rupees. That will be adjusted here. That will be adjusted here. No problem. No problem. We have already passed the journal entry here. Create the bad debt. Provision for doubtful debts. Second entry being pass the journal entry for the bad debt and adjust this for adjusting the PDD. That's separate. The amount created here being 100, used for bad debt purpose 100, matching. Okay. Second scenario, we have created the PDD 80 rupees, but actual bad debt what happens? 100. You created 1 lakh rupees for the Diwali celebration over the 1 year. So if there is a shortage, 80 can be from here, balance 20 could be directly from P&L account. Directly from P&L account. Is that clear? If the amount is sufficient enough, no problem. If it is shortage, to the extent of 80 can be adjusted in the PDD, another 20 rupees we can take from the profit and loss account, from the salary account. Fund is over, then contribute from your other amount. And what about the third scenario? Third scenario, bad debt, PDD and P&L account. The amount created being 120, but actual bad debt is only 100. What happens then? What happens? We have excess fund. For the Diwali celebration, you keep it aside, 1 lakh. But all the spending for the Diwali comes around rupees 80. 20,000 surplus is there. What you can do? What, sir? We are always in need of fund. Whenever there is a surplus, give me. Immediately take for the other spending. You can release this to again P&L. These are the 3 scenarios. For the calculation purpose, to find out how much there is a shortage or surplus and then the past journal entry, the set I am giving you is enough. Right, let's see. Now, working note 1, okay, working note number 1 is all about related to the balance sheet item. How the debtors will be adjusted in the balance sheet. Debtors balance. First, from there, any bad debt to be adjusted means given in the adjustment. Given in the adjustment is subtracted. Is that clear? First, you have to subtract debtors minus bad debt given in the adjustment. I thought I may get 1 lakh rupees from the debtors. One fellow is absconding. So definitely I cannot get the money from him, which is around 10,000 rupees. From the 1 lakh, you subtract the 10,000, 90,000 rupees I can get. Is that okay? Apart from that, in that 90,000, we have some doubts, sir. Somebody may again become insolvent or may not pay. Okay. Can we create a provision for that? So now we have to create a provision out of this amount. That is called PDD, provision for doubtful debts. Where? Given in the adjustment. Okay. So you created the PDD, Diwali fund you created. During the Diwali you celebrated. Next year also again Diwali is there. Now you create the fund for the next year Diwali. Last year created, used in this year. This year you are creating to be used in the next year. To be used in the next year. That comes as usual. This is all about the next year's requirement. This is next year's requirement. This is all about bad debt not adjusted. The final value will appear in the balance sheet. Okay. This is working note number 1. Working note number 2 is all about what about the means surplus or shortage to be recovered from the P&L account or reversed to the P&L account. If there is any shortage in PDD, bring it from the P&L account. If there is surplus, give it back to the P&L account. For that, working note number 2. Working note number 2. This is the item going to be appearing in the P&L account. Bad debt is a loss. Bad debt is a loss. Bad debt may be given in adjustment or in trial balance or both. No problem here. Both will come. Both will come. Bad debt in the trial balance, bad debt in the adjustment, both will come. Bad debt in adjustments means we have not passed the journal entry, so we have to pass the journal entry. Means you have to subtract from the debtors and then transfer to the P&L account. 2 entries are there. That's why one is here, another one is here. If the bad debt is already available in the trial balance, means already it is adjusted with the debtors, you have to transfer only these two. Is that clear? Isn't it? So here what happened? Bad debt, bad debt. 2 entries are there. One is for the subtraction, another one is adjusting the P&L account. But while debiting P&L account, the adjustment item as well as the item given in the trial balance both will be subtracted or debited to the P&L account. Is that clear? Hope so you could understand. So while posting the values in the P&L account to find out whether there is a shortage or surplus. Shortage means bring it further amount from P&L account. If there is surplus, return to the P&L account. Okay. So bad debt in adjustment, bad debt in trial balance. Bad debt in trial balance. Bad debt in adjustment and bad debt in trial balance. These are the 2 items we lost. For the next year Diwali celebration, we have to keep it aside, right? That also you are bringing money from where? In the P&L account only. So for that. So provision for doubtful debts for the next year. Usually the provision supposed to be created for the next year is given in the adjustment. So I use the term ADJ, adjustment. What are the losses to be debited in the P&L account? Bad debt given in the adjustment, bad debt in the trial balance, both will be debited to the P&L account. Apart from that, any provision required for meeting the future bad debt losses also be debited in the P&L account. But here, last year we have created the bad debt provision for bad debt for adjusting these losses. That is given in the trial balance or opening provision for doubtful debts. Opening provision for doubtful debts. That may be available in the trial balance. That can be subtracted. This is given in the trial balance. Is that clear? It means this bad debt is adjusted in the PDD. Which PDD? Opening PDD. Opening PDD. Clear? So, bad debt given in the adjustment, bad debt given in the trial balance, these two are actually a loss. As we face the loss, we are double cautious. Next year also we face the loss. We can create one more amount for that purpose also. If you go to the shop, okay, to purchase some item, you want to purchase some materials for your study, CA study or CMA, like calculators and book. How can you expect the money from your dad? Huh? Okay, calculator around 400 rupees, book is around 600 rupees. There some other pen and stationery item maybe around 100 rupees. How much is the value now? 400 plus 600 plus 100. Now tell me, how much will you get from your dad? Will it be exact 1100? Give me 2000 rupees. I will bring it back. Any balance is there, right? The same happens here. Okay, the bad debt trial balance is already you have in your purse 200 rupees. You estimated so much money, you collected another 2000 rupees from your dad. 200 plus 2000, 2200. Okay, that 2200 is not only for the expenses, for the extra expenses also you thought so. Okay. Already if you have anything in your purse can be subtracted. So you say You need a calculator for rupees 400, book 600, another stationery 100. Apart from that, what happens? Something extra happens, what can we do? Take another reserve 400 rupees. These things are the expenses are named as bad debt. This is nothing but provision for doubtful debts. Give me some extra debt. If something happens negatively, I cannot come back again for that money. Calculator, I thought it was 400, but the moment it comes under 500 rupees, what can I do? Give me extra. That is called the provisions. Now you have how much? 1500. What about the earlier balance? I have 300 rupees in my purse, sir. I have already 300 rupees in my purse. That is called provision. Opening balance or the balance available in purse. So 1200 rupees shortage, you are getting 1200 from your dad. Clear? Bad debt. Some contingencies for the future PDD for the new year or next year minus anything already available. Anything already available. You subtract this. You subtract this. This balance may be positive or negative. This balance may be positive or negative. Okay, here what happens? Positive. Suppose the amount already available in your purse is 2000. What does it mean? Your dad says, you have 500 rupees excess. Return that. Return to me now. So, there may be shortage or excess. In case of shortage, you have to get it further. It means debit to P&L account. If you have surplus, return to your dad. So, credit to P&L account. Okay. Return to your dad, credit to your P&L account. That's all. Clear? Hope. Before you proceed, you need to prepare these two working note. Working note to be posted in the balance sheet, as well as working note for the amount to be debited or credited in your P&L account. These two. Now, what are the journal entries I am going to pass? What are the journal entries I am going to pass? Okay. Journal entries. Now, for all these adjustments, you have to first pass a journal entry. For the bad debt given in the adjustment. What is journal entry? Bad debt is a loss to debtors. Is that clear? Bad debt here. Clear? Bad debt account debit to debtors. Now, what is the final entry you have to pass here? Either it may be, if there is excess, you can return to P&L account. If there is a shortage, debit to the P&L account. Okay. So for that, second entry, I just pass this one. Clear? Or the bad debt to be adjusted in the provision for doubtful debts. For this, you can pass the next entry. Third entry is a shortage or surplus. Either or. Any bad debt you found out, that will be now transferable to the P&L account. But in this case, PDD account. PDD account debit to bad debt. Clear? This bad debt is all about adjustment bad debt. This bad debt is all about adjustment and trial balance bad debt. Both. Because both is adjusted here. Third entry is to find out the shortage and surplus. If there is any shortage in the PDD, that shortage is recovered from the P&L account by debiting. So if the balance is shortage, okay, or the balance is positive in this working note number 2, you have to debit the P&L account and create the PDD. Or if there is surplus, minus item, then it can be transferable to the PDD P&L account back. It's an income like, so again credit to the P&L account. These are the two journal entries. Three journal entries you have to understand. Okay. Any bad debt given in the adjustment, you have to pass the journal entry. I have passed. All the bad debt will be adjusted where? In the PDD account. I already told you the purpose of PDD is to adjust the bad debt loss. We adjusted that. And find out whether the PDD is having sufficient balance or shortage or surplus. Sufficient balance matching, no problem. Finish up. If there is a shortage, raise the PDD by debiting to the P&L account. If there is surplus, return it to the P&L account. These are the set. These are the set. Apart from that, clear. So let me again explain once again. So what you have to do? Let me explain faster. Listen. How can we record in balance sheet? Debtors minus bad debt where given in the adjustment and PDD for the next year, usually given in the adjustment. Okay, usually given in the adjustment. Clear? This is the way we can pass the working note number 1 to be posted in the balance sheet. What about in P&L account? Any bad debt will be adjusted in the PDD. After adjusting the bad debt in the PDD, if there is a shortage or surplus, that will be adjusted, routed through P&L account. What? Bad debt. Bad debt, not only the item given in the adjustment, and bad debt given in trial balance should also be along with the next year's PDD. Okay, next year's PDD usually given in the adjustment for the next year. This is the overall fund we are in need for the adjustment. We already have what? PDD in the trial balance. In the trial balance means opening. Already we have the money in the purse. So I am using this here. After that, find out whether it is a shortage or surplus. Shortage means it's a plus number. In case of surplus, we will have minus number. This will be debited to the P&L account. This will be credited to P&L account. That's all. That's all. Is that clear? So while passing the journal entry for this one first. Second, adjusting the bad debt to the PDD second entry. Third entry is all about either of these two. Okay. Clear? For the bad debt, the journal entry being bad debt account debit to debtors. And in case of adjusting the bad debt to the PDD account debit to bad debt. And later on, find out the balance is sufficient enough or not. If there is a shortage, debit to P&L account. P&L account debit to PDD. Or if there is surplus, one of these two entry will come. Surplus. What happens then? That surplus excess no more required is transferred to the P&L account back. Clear? See here, only 3 entries. 2 working notes, 3 entries. Once this question was asked in the CMA Inter, carrying 8 marks, Inter, only this provision. But what was expected is to prepare the ledger account, not the journal entry. You have to prepare the ledger. Now let me explain how the ledger is going to be posted. Clear? What are the ledgers are going to be opened here? Let's see. One is debtors account. Another one is bad debt account. Another one is PDD account. Of course, how this will appear in the P&L account. An extract you can post this or prepare this one also. Rare scenario. P&L account. Now, usually debtors will have the debit balance in the beginning in trial balance. Debit balance the beginning. To balance brought down in the beginning. Bad debt may be given in the trial balance in adjustments. In trial balance. So to balance brought down. Which is given in the trial balance item. PDD may be given in the trial balance. PDD given in the trial balance means it's the opening one. PDD given in the trial balance is the opening one. Which side? Credit side. So I post that in the credit side by balance brought down. given in the trial balance or opening. So when you go and see the trial balance, you have the bad debt in the debit side, debtors in the debit side, PDD in the credit side. I post that to the concerned three ledgers. Then we have passed the three journal entries. You post the three journal entries here. That's in bad debt to debtors, which is given in the adjustment usually. And in debtors, it should be other side, bad debt, which is given in the adjustment. Here PDD to bad debt, to bad debt. This will be the amount available in adjustments as well as trial balance both. And here is bad debt, here by PDD, which is given in the adjustment and trial balance. And on tallying the debtors, you get the closing balance carried on. On tallying the bad debt, this gets closed, tallied. It will not have any balance anymore, because trial balance and adjustment both are available in the debit side, both are available in the credit side, matching. It will be closed. So nominal account will not have any balance. Nominal account will not have any balance. On tallying the PDD, you will get the balance, no balance brought down, which is nothing but the balance for the future year, next year. I am creating this one for the next year. That is nothing but the value available in the adjustment. This value. Is that clear? Now tally this. Okay. Here in P&L account, P&L to PDD, and in PDD by P&L account. This is the amount created in case of shortage. In case of surplus, this will appear in the other side. So this is the comprehensive. Once you understand this, the entire concept is over. Clear? Come on, make a note of it. I may solve this illustration then. So based on this format, we will try to solve this illustration. Question number 5. Always before you proceed this illustration, start with what? Working note. Working note 1 is all about the amount to be shown in the balance sheet. The format here being debtors minus bad debt. That bad debt is usually given in adjustment is going to be subtracted. If the bad debt given in the trial balance means was adjusted already, you no need to again subtract from the debtors. Minus PDD, which is also required for the next year, usually given in the adjustment, should be subtracted. This is what about the balance sheet item. How this will appear in the balance sheet. Note number 2 is all about how this will be shown in the P&L account. Means there may be shortage or surplus in PDD, can be transferred or received from P&L account, where we have the bad debt given in the adjustment. Just now we found out by subtracting the debtors. Apart from that, we have the bad debt in the trial balance. The bad debt given in trial balance is nothing but the journal entry for adjusting this was already done before the preparation of the final accounts. That's why it appears in the trial balance. So these are the two losses. Apart from that, next year expectation is also there. That is also a loss. So for that, we have to create the PDD for the next year requirement, which is usually given in the adjustment. This is the overall fund we are in need, and minus what? If we have already any PDD in the trial balance, opening already we have, sir, then you can subtract this. Whatever the balance you get, verify whether it's a plus or minus. If it is being the plus, you have the shortage. Debiting the P&L account, you can create further. If it is minus, you have surplus, you can credit the P&L. Right. Let's see. Bad debt in adjustment 300. Debtors being 10,000. Provision for doubtful debts in trial balance. Okay, bad debt in trial balance. Sorry. Bad debt in trial balance 300. Posted twice. Any adjustment item should be posted twice. So here as well as here. Provision for doubtful debts required to be maintained at the rate of 5%. Okay, usually provision will be given in percentage. because it's not confirmed, only estimation. Out of my salary, 10% I will keep it aside for my charity purpose. That's how you'll decide. So it's only estimation. So from 10,000 banded 200 confirm will not get, so only 9,800. We expected may be receivable. Out of that 9,800, somebody may not pay me. We expect it may be around 5%. That 5% on this being 490. Am I right? Okay. So the balance amount appears in the balance sheet being 9,310. This will be shown here also because adjustment item should be posted twice, here as well as here. Now P&L account 200 plus 300, 500. From 500, 490 is subtracted. So 10, added 990. We already have the provisions of rupees 400. Then definitely this is a shortage. Shortage of how much? 590 being the shortage. 590 being shortage. Now, journal entry. Journal entry number 1 is all about bad debt for the adjustment. Journal entry number 2 is all about adjusting the bad debt to the provision for doubtful debts. Journal entry number 3 is all about shortage or surplus for the PDD to be created. So, this will be transferable or adjustable in the P&L account. Yeah, what is the first journal entry? Journal entry for the bad debt is nothing but debit the bad debt and credit the debtors. Bad debt account debit to debtors, this value being 200, and this bad debt is adjusted way in the separate fund account. So I am debiting the fund account, PDD account, debit to bad debt. What bad debt here? Both the bad debt, trial balance as well as adjustment, both the bad debt. So it is around 500 rupees. Third entry is all about set off in the P&L account. There is a shortage. Plus means shortage. So shortage can be brought from the P&L account. So debit the P&L account to PDD. The value being 590. Now I am going to prepare what? Ledgers. Okay. I am going to prepare the ledger. Right. So what are the ledgers are going to be prepared? 3 items were there, right? So one is debtors account, another one is bad debt account, another one is provision for doubtful debt account. If you want, then you can prepare P&L account, where we cannot prepare the complete P&L account, so it's only an extract. If the illustration is complete, then we can prepare complete P&L account. Here we are going to prepare only the extract. Now, what is the debtors balance we have? 10,000. What is the bad debt balance we have in trial balance? 300 to balance brought down. What about the opening, the amount available in the trial balance, PDD? 400 rupees, that in credit side, balance brought down. Credit side or debit side, that's all. You just see and post that here. So, this is given in the trial balance. I am posting these 3 items in the concern ledger. Is that clear? Thereafter, what we have to do? Incorporate these adjustment entries. Bad debt to debtors. In bad debt to debtors, the value being 200. In debtors by bad debt, the value being 200. In PDD to bad debt, the value being 500. In bad debt by PDD, the value being 500. In P&L account to PDD, the value being 590. In PDD by P&L account by P&L account 590. Now close the debtors 10,000. 10,000. You have 9,800 balance carried on. Bad debt account gets tallied 500 rupees. PDD account 990. 990. We left with balance of rupees 490. What does it mean? Any balance in PDD is for the future adjustment. Here, this one, this is a number. This is PDD balance. Is that okay? For the next year's requirement will be available here as closing balance, balance carried on. Now, how this will appear in the balance sheet, sir? In balance sheet. In balance sheet, we have the debtors balance in the debit side. Balance brought down appears in the debit side, means that account is debit balance, not carried on. Carried on is in the credit side, brought down appears in the debit side. So, debtors 9,800. Bad debt account is closed, nowhere now it will appear. PDD has a balance of 490, which is in the credit side, so it should be subtracted from here. 490. So, the debtors now appears in the balance sheet being 9,310. This value. Clear? Hope now you'll be able to understand this logic. Yes, come on, make a note of it.